You're staring at your portfolio, and all you can think about is the floor falling out. You've heard the names: Mark the Crash Guy Spitznagel, Michael Burry of The Big Short fame, and Ray Dalio. They are all sounding the alarm. Spitznagel is even out there predicting a historic 80% crash after what he calls a euphoric, historic blow-off rally. Welcome to Wealth Print. I'm Wendy Pierce, and today we're diving into something that quietly holds most people back financially, even if they don't realize it. Here, we don't just talk about money, we break down the psychology behind it so you can make smarter decisions without overcomplicating everything. If you want clarity, not confusion, you're in the right place. It's terrifying. But what if I told you that the crash itself isn't the reason most people lose money? What if the real reason you're losing out has nothing to do with the market dropping and everything to do with a massive gap between what you fear and what the data actually says? But before we start this video, I have a disclaimer to make. This video is for educational and informational purposes only and should not be considered financial advice. Always do your own research before making any financial decisions. Today, we're going to look at the cold, hard numbers that the pundits don't want to talk about. We're going to use the wisdom of crowds, specifically the options market, where people put real money on the line, to calculate the true probability of a market meltdown. And the results? They might just change the way you invest forever. Let's start with a reality check. How likely is a crash anyway? First, we have to define it. A common benchmark for a crash is the US stock market dropping at least 30% from its starting level at any point over the next 12 months. If you ask the average investor, they are braced for impact. In fact, surveys conducted by the Investor Behavior Project at Yale show that both individual and institutional investors are consistently pessimistic. Based on these surveys, there is a blended estimate that a crash has a 30% probability of happening in the next year. Compare that to the experts. When researchers asked large language models like ChatGPT and Claude to estimate the risk based on historical frequency and current valuations, they were much more conservative, giving estimates between 6% and 10%. So who is right? The fearful public, the AI, or the crash guys? If we look back at the last 100 years of US stock market history, the actual frequency of a 30% loss over any 12-month period is only about 7%. Even when the market looks expensive, like when the Shiller-Cape ratio is above 30x, that frequency only ticks up slightly to 10%. But history is backward-looking. What if the market is different this time? To answer that, we have to look at the only place where people are forced to be honest: the options market. In the options market, people aren't just giving opinions, they are betting real money. To find the real-world probability of a crash, we look at put options, which are basically insurance policies against the market falling. If we look at the S&P 500, we can find the price of a put option that pays out if the market drops 30% a year from now. By using some complex math, like the Black-Scholes model and the Heston options model, we can reverse engineer what the market actually expects to happen. After adjusting for things like risk premiums, because people usually overpay for insurance, the math reveals a startling number. The probability of the stock market dropping by at least 30% at some point over the next year is approximately 8%. Think about that. The public thinks there's a 30% chance of a crash, but the smart money in the options market says it's only 8%. This is the first reason people lose money: the fear tax. When you overestimate the risk of a crash by nearly 4 times, you make emotional decisions. You sit on the sidelines, you hold too much cash, you wait for a dip that might never come. But wait, it gets even more interesting. Using that same math from the options market, we find that the probability of the stock market rallying by 30% over the next year is actually 11%. You are literally more likely to see a massive 30% surge than you are to see a 30% collapse. Yet how many headlines have you seen lately warning you about a historic blow-off rally? None. We are hardwired to fear the 8% risk while completely ignoring the 11% opportunity. This leads us to the second and perhaps most important reason people lose money: misunderstanding asset allocation. Most investors believe that if they know a crash is coming, they should change their entire strategy. But the source material for today's video, based on the book The Missing Billionaires, argues something radical. The optimal amount of money you should have in stocks is driven by 3 main things: the expected return of stocks over bonds, the overall variability or risk of those returns, your personal degree of risk aversion. Here is the kicker. The actual shape of the risk, meaning whether the market drops via a sudden crash or a slow grind, hardly affects what your allocation should be, as long as the total variability stays the same. In other words, a crash shouldn't be the driver of your investment decision. It should be an output of your strategy, not the input. Ralph Waldo Emerson once said, "Knowledge is the antidote to fear." When you treat a stock market crash as an unknown unknown, it's terrifying. It feels like a monster under the bed. But when you transform it into a known unknown, when you realize it's a statistically measurable 8% risk that is baked into the very nature of investing, it loses its power over you. Stocks offer a higher expected return than safe bonds precisely because they are variable. If there were no risk of a 30% drop, there would be no risk premium for you to collect. So, what should you actually do? First, stop letting pundits who are vague about timing dictate your financial future. They might be right eventually, but as the saying goes, even a broken clock is right twice a day. Second, recognize that your own brain is likely overestimating the danger. If you're feeling 30% worth of fear for an 8% risk, you are paying a psychological tax that will eventually show up as a smaller balance in your bank account. Finally, focus on the variables you can control. Your personal risk aversion and your long-term expected returns are far more important than trying to predict if this year is the one where the 8% probability comes true. The real reason people lose money isn't the crash. It's the panic before the crash, the hesitation during the rally, and the failure to understand that risk is the price of admission for long-term wealth. The market might drop 30% next year. It's an 8% chance. But it might also go up 30%. That's an 11% chance. Which one are you going to bet your future on?